Welcome back to another video. Today we're going to be discussing a more broader economic set of data and discuss the most recent unemployment rate, inflation numbers, job openings, and see how that correlates to mortgage rates and in turn how that could impact the housing market. So let's get straight into it. So first, the unemployment rate more recently actually went down to 4.3% from 4.5% at the end of 2025. Now, unfortunately, the Federal Reserve does monitor what the unemployment rate is doing, and that is a major set of data for how many rate cuts they're going to do this year and if they're going to continue with their rate cutting cycle. And remember, historically, the average unemployment rate over the last 50 years has been between 5.6 and 5.8%. And at 4.3%, that is a very, very low number compared to what it has been historically. So the Fed is looking at this number saying, if the unemployment rate is this low and we just continue cutting rates month over month, we could potentially run the risk of having inflation coming back and being even worse. Because if we have supposedly majority of the population employed, unemployment rate at historically low levels, and we keep cutting rates in order to loosen up the economy even further, then everyone who has their jobs will more than likely continue spending even more money, and companies will continue to hire more people. And as a result, inflation could come back even stronger. So the Fed is monitoring this number very closely, as well as the inflation rate, of course. So the unemployment rate has been on a pretty steady uptrend over the last 2 to 3 years. You can see we kind of bottomed around 3.5%, somewhere around there, and has been slowly trending up. However, when we look at job openings, this tells me that we are likely going to see the unemployment rate continuing to trend higher. You can see this has, over the last few months, has been dropping pretty drastically. And you don't really see this kind of drop unless we're looking back at previous recessions. So in my personal opinion, I do think companies are definitely not in an environment where they're spending an enormous amount of money. I know in the tech industry, they are continuing to invest in AI, expanding AI, and that is one of the sectors where money is being invested in heavily, but that doesn't necessarily lead to more jobs. It leads to more jobs in a very niche environment, but for majority of the people, it doesn't really lead to that many jobs because there are so few people with an enormous amount of AI experience and expanding AI and incorporating AI into a working environment. So with that being said, where's inflation? Inflation has also been on a pretty steady downtrend over the last 2-3-ish years. You can see we kind of peaked around 8% in 2022. Now this is consumer inflation and the median consumer inflation for that month. But in other metrics, we peaked around 9.1%, and where we stand right now is around 2.3%. Now, I know tariffs have been a large talking point amongst economists and amongst the general public over the last year and a half or so. And the consensus about a year and 4 months ago, roughly, was by many economists that in 2026, where we are right now, inflation would be closer to 7% if the tariffs were implemented. Now, the tariffs have been implemented and we aren't seeing inflation back at those levels. Obviously, tariffs are impacting inflation. The cost of some goods have increased inevitably because there is an additional tax on a lot of goods that are being imported into the country. But inflation, consumer inflation, producer inflation, and general inflation has not really increased as much as a lot of economists and people in general would have anticipated. So had tariffs not been implemented, I would be under the impression that this number would likely be substantially lower. Now, where we stand right now at around 2.3%, If this number continues trending down closer to that 2%, which is where the Federal Reserve has stated multiple times that they want inflation to be before they can confirm with certainty that they're going to continue this rate cutting cycle, then that would be amazing news. The issue with that is generally we want inflation. We want 2 to 3% inflation. But if inflation continues trending even lower, then that is a sign of a slowing economy. Now, the Fed would likely, of course, continue to cut rates in order to stimulate the economy. But if we have an environment where the unemployment rate is increasing and we have inflation decreasing, that is basically going to confirm that the Fed can carry on interest rate cuts and maybe even do larger interest rate cuts. So all eyes are on inflation and the unemployment rate. Inflation has been in a pretty steady downtrend. This is obvious. The unemployment rate has been in a steady uptrend, but still near historic lows. So this comes back to my mortgage rate and real estate sort of analysis where I think things are going. And when people think about interest rate cuts, generally they think about that impacting mortgage rates, but that isn't necessarily the case. We know this because in 2024, the Fed actually cut the Federal Reserve base interest rate by a full percentage point. And that actually led mortgage rates even higher. The Fed cut rates here in September of 2024, and you can see mortgage rates, which is this green line up here, actually went substantially higher. And that is because the 10-year Treasury yield went higher. The 30-year fixed mortgage rate is essentially directly tied to what the yield of the 10-year Treasury is. This is very obvious looking at this chart. The blue line is the 10-year Treasury. The green line is the 30-year fixed mortgage rate. And what impacts the 10-year Treasury yield? Well, it's essentially economic data, amongst a few other things, obviously demand for bonds and investors in the bond market. As demand increases, the yield of the Treasury declines. As demand decreases, the yield of the Treasury increases in order to attract more buyers. But this is 100% impacted by economic data. If the economic data comes in much stronger than anticipated, then the 10-year Treasury increases. As a result, the 30-year fixed mortgage rate increases as well. Going back to my 2024 example, when the Fed cut rates by a full percentage point, why did the 10-year Treasury yield increase? It increased because the economic data was significantly stronger after the Fed cut rates. We saw the unemployment rate decline. We saw inflation go up. The consensus was that the consumer was full steam ahead, spending money. Job openings were relatively high. So investors said, why did the Fed cut rates when the economic data did not warrant it? And as a result, the 10-year Treasury increased and the 30-year fixed mortgage rate increased. So if the economic data continues to worsen, which in my opinion it will, I believe the job openings will continue to decline, and that will eventually lead to the unemployment rate getting back to its historical average of around 5.6 to 5.8%. And that in turn could potentially lead inflation to continue declining, getting closer to that 2% mark. Of course, tariffs are going to be a large caveat. They seem to be changing on a monthly basis. So that is absolutely going to have an impact on consumer inflation and general inflation altogether. So if we have what I believe will occur this year or into 2027, then that will actually lead mortgage rates to decline. And I know there are an enormous amount of buyers sitting on the sidelines waiting for 5.5% rates before jumping back into the market. And we're seeing pockets of the country have high inventory, pockets of the country have low inventory. Where I live, Orange County, California, buyer demand is outpacing seller supply, and homes are yet again selling for above list price. But in other parts of the country, I know parts of Texas, parts of Florida, you're seeing inventory has continued to increase and the buyer pool has declined. So you are seeing a lot of price drops in areas of those states. Obviously not the entire state, but in areas of those states, you are seeing price reductions. But a 5.5% mortgage rate, which could be seen in 2026 if the economic data warrants it, that will 100% spur a lot more buyers jumping into the market. So if you're sitting there wondering, is it a good year to buy? Is it a good year to sell? It really depends on your local market. Here, for example, there's not enough homes available for sale. And yes, there are buyers jumping into the market. I've written a couple offers this year, and unfortunately, they already had multiple offers over list price in my area. But here's what I will say. If mortgage rates continue to decline this year, which is my base case scenario right now, then I do believe buyer demand will continue to increase, and unfortunately, it will likely drive prices higher. If the unemployment rate gets back to its historical average of around 5.6%, the Fed will definitely be in an environment where they can confidently continue cutting interest rates. They might not do large cuts, they might just do a 25 basis point cut, which is 0.25% every month. As it stands, the market is currently anticipating the next interest rate cut to be in June or July, which, funnily enough, is when the chairman of the Federal Reserve is expected to switch. Jerome Powell is no longer going to be the chairman, and someone else, whoever Trump chooses, is likely going to be the new chairman of the Federal Reserve. So that could also be a factor. But the reason I'm making this video is because I'm seeing so many people say, oh, interest rate cuts is going to be the cause of mortgage rates declining, but it's not really always the case. We sometimes see mortgage rates decline even without the Fed cutting rates. And more often than not, the day the Fed actually cuts rates, mortgage rates don't really do anything. What you want to see is the economic data declining. You want to see the unemployment rate increasing. You want to see inflation declining as well. That will lead to much lower mortgage rates. We're already seeing lower job openings, so I wouldn't be surprised if the unemployment rate, remember, it's a very delayed data set. I wouldn't be surprised if that increases 6 months from now, because job openings have declined, layoffs have increased. We saw they revised the 2025 hiring numbers by 1 million, so there were 1 million fewer individuals that actually got a job than their initial data suggested. And of course, if we do get lower mortgage rates, then there will likely be an increase in demand for the housing market, but it really depends on your local market how that will be impacted. There's a lot of people on social media who just put a basket around the housing market and say, if this, then that. But it really depends on your local market. Yes, lowering mortgage rates will absolutely increase the buyer demand, but if in the local market where you're in, sellers are continuing to list their home, days on market is increasing, price drops are happening, then a 5% mortgage rate might not be enough to spur a buyer frenzy and to spur those homes selling for multiple offers over list price. But areas where inventory is already constricted and is a major issue, then that will likely cause homes to increase in value and get multiple offers. But that's it for the video. Let me know your thoughts in the comments. If you like this video, subscribe for more. I try to incorporate a more broader economic sort of what's going on, how that impacts the housing market every week or so. And then I mostly talk about Orange County, my local market, because that's what I am more familiar with. But the broader economic data does absolutely impact local markets as well. So let me know your thoughts in the comments. If you like this video, subscribe for more, and I'll see you next time.